Welcome to Srihari's lessons. Hope you enjoy your time here. Continue listening and supporting. Hello friends. Let us discuss in this chapter about returns expectations. This is the most important element in your analysis of choosing the instrument for placing your money. This is one of the most important elements in a person's financial journey and accumulation journey. Without knowing about how to fix the expectation on the quantum of returns, you cannot decide on the instruments or modes to put the surplus money. Another aspect in this video is that there is going to be a shift in geographical focus. So far in all the previous chapters, I have tried to remain geographically neutral in the ideas discussed or examples cited, etc. From this chapter and going forward, we will be focusing more at an Indian perspective. In other words, the ideas, events, examples, etc. will be relatable more in Indian context. Hope this is fine with the audience. Return expectation involves understanding two factors. First one is the returns benchmark available. Second is the quantum of risk involved and one's ability to face and overcome the risk involved. Each instrument that is being analyzed for putting the money will have relevant returns benchmarks and risks involved, and we shall discuss the benchmark rates and risk element of each instrument when we are discussing about that particular instrument. At this juncture, we shall understand the generic concepts of returns benchmarks and risks. In financial markets and in many other places, both these elements are analyzed together and generally referred as risk-reward analysis. Let us start with discussing about return expectations. We get to see lots of news stories about people losing money by putting them in some dubious companies or institutions. One common factor in most of these cases is that the fraudulent institution almost always attracts people by guaranteeing an exorbitant or impossible quantum of returns. Common people get attracted to or fall prey to these dubious guarantees possibly because of three reasons. First one could be that they need to grow their money quickly to meet some expenses and hence gets attracted by the high returns offered. Second reason could be that they are greedy to make more than normal returns and hence choosing this route. Third reason, which might also be invisibly present in the first two reasons, is that there is not sufficient knowledge or awareness among people to identify these frauds and protect themselves and their money. It is not practically possible to do anything for the people getting trapped by the first two reasons. At least for the third reason, we can bring this awareness to the society, and this is also one of the purposes of this series. We have mentioned here these as fraudulent institutions. Who are we to judge them and call them fraudulent? Yes, we are not legal authority to make those judgments. Out of such news stories, if the legal authorities have made judgments, then we can conclude based on the court verdicts that these are frauds. However, from our side, just by looking at the exorbitant and abnormal rates, we can simply stay away from them and protect ourselves. Now let us get back to matters relevant to the series. We have mentioned the above returns offered are exorbitant. What does that mean? If something has to be called exorbitant, then there has to be some normal, right? This is what we are going to discuss here. Federal banks in different countries regularly and periodically announce their operating interest rates, which are normally referred as benchmark interest rates. In India, the Reserve Bank of India announces on a quarterly basis their benchmark rates, which is called as repo rate and reverse repo rate. These are rates at which Reserve Bank of India lends money to the banks and when banks deposit money with Reserve Bank of India. There are a lot of rules, regulation, statutes and law governing the banking operations, and let us not get too much into that subject. The repo rate announced by RBI serve as benchmark rate for other operations in the country. Banks fix their deposit rates and their lending rates based on the repo rates as the base. There are again a lot of regulations and guidelines based on which the banks fix their deposit and lending rates. However, most times repo rates are the basis on which banks fix their rates. The governments, both central government and state governments, fix their interest rates like small scale saving schemes etc. based on the repo rates. That way, the interest rates of all financial operations in India by all the players in lending and deposit transactions are driven by or based upon repo rates by RBI. If this as a subject interests you, a separate video can be made on this subject in future. For the purpose of this series, we need to understand the effect and impact of repo rates on the interest rates operating in the country. We should stay in touch or at least know to refer the repo rates and historical tendencies of relationship and movement of rates by different players in alliance with the repo rates. That will become a guiding principle in our decision making process in managing our personal finance. This is only one part of the story. Not all financial instruments are based on or dependent on interest rates. In the list of instruments we mentioned in the previous chapter, maybe the first one will be mostly based on interest rates. All other instruments will not be entirely dependent on interest rates. There will be some proportion of impact of interest rates on all instruments. However, there are very many factors that will have impact on the returns or growth of financial instruments. For example, if you are buying shares of a company, the company's ability to generate profits and risk involved in company's performance and growth are huge subjects on its own territory. Yes, there will be impact of interest rates on company's profits, but that is only to a limited extent. Or in other words, interest will be only one of the elements that will impact company performance. There are other factors for other instruments. When we discuss each of the instruments along with the channels and analysis methods, we will cover risk-reward factor for each instrument. Now coming back to benchmark repo rates in India, this will act as a fundamental base or foundation for almost all the financial operations in the country. We have also seen the financial markets are based upon simple demand-supply mechanism. This demand supply will have effect of interest rate directly or indirectly through impact on liquidity and inflation. Therefore, this benchmark repo rates will have a bearing on many of your decisions in your financial journey. Please do not think this is too much financial jargons or economic concepts. I hope and I will try to simplify all this when we discussed each instrument in future chapters. Let us also touch upon about risk element or the general concept on the same. We have already discussed money loses its value when kept as it is, and hence we put the money in different instruments to protect and grow its value. When we analyze an instrument, it is not only about the instrument, we should also understand about where the money is used by the person receiving the money from us and how they are making money. This is in other words referred as application of money. Understanding where the money is ultimately applied defines the actual risk involved in use of money. This understanding shall also provide an idea about the offered returns against the benchmark returns on the use of money. We shall discuss this in future chapters in much more detail for each of the instrument. Now we have mentioned in earlier chapters, you have to place your surplus money in the most suited instrument in alignment with your goals for present and future expenses and reaching your financial independence. However, Choosing the right instrument based on your circumstances will involve a lot of analysis and understanding. Over a period, when you keep doing this time and again, this becomes an easy task. Going forward, we shall look at the various channels or modes available for placing your money, and we shall start discussing the different instruments one by one along with their channels of placing the money and analysis methods. With that, I'll close this. We will see in the next video. Thank you. Welcome to Srihari's lessons. Hope you enjoy your time here. Continue listening and supporting.